All right, folks, welcome back. This is episode 18 of the continuing series of the ICT 2022 YouTube Mentorship. All right, so we are looking at the Eurodollar. Upper left-hand corner is always going to be the daily chart. As you can see here, daily. Now, if you're looking for bias, you're going to start your analysis here. Number one, the bias is bearish. So if a bearish bias is being implemented, okay, in other words, you're using that in your analysis. You're going through the charts, looking for setups that would warrant a short sale on this particular market or this pair in Forex. What I'm showing you here, all of this up to now, if I make a transition to index futures trading, I'll mention certain caveats when it comes to that. But for now, everything I'm saying in this video, until I say otherwise, is pertinent to Forex. Okay, so it's specific to Forex. All right, so bias is bearish, and we're looking at a daily chart. So you start your analysis there. You have a fair value gap here. So it can trade up into that, and all you have to see is that candle traded to there. And we're going to bring in the element of time of day and how that helps you decide what you're looking for. So ideally, what we've seen here, we had 1, 2, 3, 4, 5 down days. Now, there's likely to have a retracement because we've seen it come way down in terms of the range between this low and this high. So what does that make that area down here? Premium or discount? Discount. So as soon as this fair value gap forms, we know that it's likely to see it rally up into this area here. In other words, a short-term little bounce. That occurring and trading back to this candle's high is enough to set the stage for a new round of selling. So you highlight your area on your daily chart and then look at what we have in terms of targets. This is an ideal scenario, that low, but it's not likely to do that in one day. Can it do it? Absolutely. But look at what is available in terms of targeting. This day here, it created the fair value gap. So that means we can go in and note that low right there. And we're going to put a little line segment here on this daily candle, and we'll mark that one red. Okay, so we have more or less a premium level that's being highlighted. And you can see it touches it, but it actually goes above it just a little bit. And that's all we'll need to justify a framework. So you frame your daily highs and lows, previous daily high, previous daily low. So we have this day here, yesterday's trading. And then Thursday's trading, we opened here, we rallied up, popped just above that short-term high. And now because we've seen that, we can target that daily low right here. Okay, so this is the trading day on Thursday. We open, rally up, create a Judas swing, run back into this fair value gap, and then expect it to sell off. And then we can aim for that daily low. Why? Because anybody that went long in here, who would want to do that? There's always buyers and sellers. Okay, so we're going to use previous day's highs and lows like institutional mindset traders do. There's lots of liquidity around daily highs and lows. And high-frequency trading algorithms attack previous day's highs and lows. So we have our framework here. We have the premium and discount. So these two levels are represented on the high and low of Wednesday's trading, which would be yesterday's trading. In other words, your chart would have looked like this. Wednesday going into Thursday, before Thursday started trading, you'd have this. So you would mark your chart out like this. So if we go up here and we enter this fair value gap, that's your opportunity to go in looking for shorts. Then if it starts to go down, you're targeting this low with the expectation. Why is it likely to do that? Because it may want to go down to this low, but this gives you a nice range of profitability, potential profitability. So we're going to drop down into the lower time frame. So in here, it's this imbalance on the daily chart, but now we can see it also exists in the hourly as well. So we have what? This high and this high. What are they? They're relative equal highs, anchored to that point right there. Having something like that, more information zoomed in to a specific area, and then simply go in and start working with the 15-minute time frame, because this is all I would do with the hourly chart, because the frame of reference is that daily fair value gap. We have liquidity pool on the hourly chart. We've already mapped out the 6th of April's low. Notice there's no lower low. This low didn't go down to it. And we start a new day on the 7th here at midnight, New York local time. What do I mean by New York midnight? I'm going to answer that. Let's go to the 15-minute time frame here. And as you can see, we already have that little annotation updated on the 15-minute time frame. All right, so now we have on the 15-minute time frame, we're going to annotate the daily dividers. This all is a little vertical line. What is the opening price at New York? Midnight. That's this candle, and you highlight that, and this price right here, that right there, if you're looking at the time frame on the hourly, that would be the opening price. I'm interested in that on a 15-minute time frame, or if I'm going to be scalping, I'm going to use the 5-minute chart. Okay, and then I'll put 2 reference points on the 5-minute chart. But for the sake of this discussion, just know that that's the actual price I'm looking at, and I'm drawing that out in time. How far am I drawing it out? 11 o'clock in the morning, New York local time. All right, so now we have the buy-side liquidity pool, the daily delineation of midnight New York time. And now we have the relative equal highs here. We rallied above them. Once it hits this, do we get displacement? Now we get down to the nitty gritty. Okay. We have a swing low here. It breaks down below that. And then once it does that, does it create an imbalance? Is there a fair value gap? Nudge, nudge. You see that? All right, so we're going to annotate that. So inside of this range here, we have a fair value gap. We're looking at the market wanting to go higher first to go lower. And here's that midnight delineation, starting a new day. We rally up and then we break down. So what's the model teach? Trading when? The New York session, okay? So we're trading the New York session. In Forex, it's 7 o'clock in the morning to 10 o'clock in the morning, right there, okay? So 10 o'clock in the morning and 7 o'clock. So we're looking for a setup that would be formed within that time frame. So the New York kill zone, it runs up into that, runs the highs, and we want to see a displacement to the downside. We get it right there, okay? So now you have this area here, and then you would put your order in right there. What time is that? It's 10 o'clock. So you put your limit order in to sell short right at that price right there, or plus 1 pip period. And your risk is going to be above this high. The imbalance is really stretched out. You can use that as your stop. If you're really concerned, you can put your stop above the swing high. But whenever you have a big range like that, my stop can place right there. So your stop would be here, and you're going to go short here. That's the minimum expectation using the 15-minute time frame. But we're going to split the 15-minute time frame down into 5-minute intervals. Okay, so we're going to look inside this range here and see if it's advantageous for us to go down into a 5-minute chart. And does it have a fair value gap in that? All right, so we're looking at the 5-minute chart now, and it's that shaded area here. So it's using this specific candle, or that low. And we're looking inside this range right here. Okay, so it's this decline we're looking at. Does it have fair value gap? Well, we have this small one right in here. See that? We have this stretched out one here. Yes. And then we have all this run in here where it has a small little fair value gap. So now think about what's been shown. On that 15-minute time frame, we have a minimum threshold of at least reaching into this low. Okay. Remember I showed you on the 15-minute time frame that imbalance. So it needs to get up into that. The higher time frame imbalances are going to be parent to the subordinate smaller time frames. Okay, the parent, okay, is this 15-minute time frame imbalance. So it needs to get above that. But when it does that, we have to look at the lower time frame below 15-minute time frame, which is the beginning stages of our fine-tuned entry of 5, 4, 3, 2, and 1 time frames. So here we have the 5-minute chart. We have an imbalance right here, and then we have that small one right in here, and all the way up to this price point here, we could factor that in, but it's not likely to get up there. So we can look at what? This level here, that is the minimum expectation. You can put a sell limit order there to go short, or you can fine tune this to rebalance all the way up to here, right there. In other words, it would look like this. This would be your imbalance on the 5-minute chart. And if it traded up into that right there, okay, in other words, you could use any specific price in this range here you can pick. This is where the unique style for you comes in. If you get greedy, you may not get your fill. But long story short, this would be your range you can work within, and it trades up into that secondary fair value gap. Now, some of you might say, well, what happens if I put a limit up here? Well, that would be obviously a stellar entry, but you don't necessarily need that. Why I like this one is because if you look at the 15-minute time frame, it was like this. That was the range, okay? So if we go up in that range to the upper end of it, look over here. What do we have? All 3 of these candles here. 1, 2, 3. The order block begins with this candle's low. It's 1, 2, 3 candles making one consecutive bearish order block. So the logic is we ran up into this daily fair value gap. That's what this level is up here. This red line was those relative equal highs on the hourly chart. Remember that? And this run here is the run into that imbalance and above the relative equal highs. So this is the bearish order block. It's the consecutive run on this time frame, the 5-minute chart. What makes an order block valid? It has to have an imbalance. Without the imbalance, there is no order block. The order block is all 3 consecutive candles. The reason why this last up close candle is not even traded to is because the higher time frame parent imbalance, that 15-minute time frame, which is being shown here, that range of that low and that candle's high here, it stops there. So there's no necessity for it to trade up into that last candle. So if it trades up into this candle here, the bottom one, the last one of the 3 going up, that's enough for me, and take that over here, and then we have this imbalance. So in my mind, this imbalance is sufficient. We don't need this one, and you wouldn't expect that last up close candle to be traded to. So this is the ideal scenario that I think the mentorship on YouTube should be looking for. Now, as soon as you have this is one you settle in on. What are you met with? Another little fair value gap right above it. So what were the rules that I gave you when it has that in the chart? Think. It is going to be a likelihood that it could trade up in there, but your limit order to enter is down in here because it might not get up here. What am I trying to do? I'm trying to teach you how to avoid missing trades, because a lot of you are going to want to put an order up in here. And yes, it would have been filled on this instance, but many times you're going to have an order placed at a really overzealous price point that if you nail it, it's beautiful, but they don't happen a lot. It's fleeting. It happens once in a while. So we had a break in this low here. So there's an internal shift in market structure. It's bearish. We have the imbalance here that's been refined down into the 5-minute chart in concert with the bearish order block, the lowest down close candle. We've talked about why we're not looking at the last up close candle before the down move. So we're canceling all that misconception. And it runs up into the level with the rule I gave you. If we settle in on a fair value gap and it has a small one above it, expect that it might trade up there, so your risk has to incorporate that. So that's the reason why I'm telling you your stop loss could be here. What is an order block? It's a change in the state of delivery. The algorithm changes its state of delivery. As soon as we get below this candle's open, the market starts delivering sell side, and then it breaks this swing low. So now we have changed gears internally. Any rally after that is just setting up another run to go lower. So in other words, this is a suspect rally, okay? So this is an intermediate term high, swing high, because it has the imbalance. It should not trade higher than a high. That's the reason why I'm telling you, you can put your stop loss there. You see how the rules are coming together? Now, what happens if it doesn't fill you by 11:30? Pull the order. It's it. Don't put it good till cancel. Just pull it, because you want to be entering on the day that it creates this, because relative equal highs, if it doesn't drop off, it could come up in at a time of day where you don't really want to be there, and it could fill you and then keep on running and take out the relative equal highs at a deeper pass and then stop you out. So it's important to know why the kill zones are there. Kill zones are when you determine your entry and you place your orders and then you walk away. You don't need to have your entry filled inside that kill zone window. Your order idea and your order placement needs to be considered at that time. If you can't derive a order placement for setup or trade entry by that time, you have nothing to do. And that's it. You've basically taken no risk on, and you have to wait till the next trading opportunity or trading day. And then the market obviously starts to break lower and then trades to it here. So at 245, it fills it, and that's the end of that.